Well, thank you for joining me today to see the exact Excel spreadsheet that I'm gonna be using to make myself thousands of dollars. Now, this is a new strategy that I'm using. I'm building a spreadsheet to track the dividend dates of certain stocks on the market in order to use this strategy. Now, I'm not gonna be buying stocks long-term and holding them for the dividend. No. I'm not going to be swing trading or day trading stocks to try to get my name on the ledger in order to claim the dividend for said stocks and then sell them. No. I'm going to be using a put option strategy in order to capture the value arbitrage between the night before and the morning of the ex-dividend date. And I know I said a lot of words. I'm going to get into the video and show you exactly what I mean. We're going to start off this challenge, this strategy, this new strategy, and test it with a paper trading account. And then, if all works well, we get to move some real money in and have some real fun. Now, let me show you, this is accessible to anyone. Go to Google Chrome, type in, what is an ex-dividend date? And you're gonna learn what an ex-dividend date is. The ex-dividend date for stocks is usually set 1 business day before the record date. Now, a record date for a stock is the date that it records all of the shareholders of that said stock in order to make them eligible to receive the dividend when the stock pays out the dividend, right? Let me click the first question on Google because this will be so simple for us to understand. Will I get a dividend if I buy on the X date? And here is where the trick is. An investor must be a shareholder before the X date in order to collect dividends. If an investor purchases shares on or after the ex-dividend date, they will not be entitled to a dividend payment. What did we just read? If you are a buyer of a stock before the ex-dividend date, you are entitled to receive the dividend. Let's call it XYZ stock that pays 5% per quarter. High dividend. Anyway, maybe it's a limited partnership, not a stock. But anyway, XYZ limited partnership pays you 5% per quarter in order to hold shares. And they pay you a dividend, and the way that they know that you own the stock is via the record date where they record that you own the stock. And the cutoff date to get on the recording list is the ex-dividend date. So if you buy the stock before the X date, you are entitled to that 5% dividend whenever they pay the dividend, usually a few weeks after that date. If you buy the stock the morning of the ex-dividend date, right? So just the night has passed. You buy it. You're not entitled to that 5% dividend. You see where I'm going? The stock market generally reflects this because the stock is viewed as 5% less valuable because there's no dividend entitlement. So this is where my strategy is going to occur. Essentially, I go on the NASDAQ dividend calendar and I see, okay, today's July 26th, but we're going to be buying our put options tomorrow morning. So we're going to look at ex-dividend dates of Friday, July 28th. Now note, say if I were to buy ADC the night of 7/27, I'd be entitled to this 24-cent dividend. But if I were to buy it on 7/28, anytime during the day, I would not be entitled to this dividend. So the theory goes that ADC stock should fall in price, share price, by 24 cents, theoretically, to capture the loss in value of the ex-dividend date. And this is all theoretically, but we're going to be doing a put option strategy on this exact thing. So this is where my spreadsheet comes into play, where I'll be analyzing what my picks are going to be. Because if you notice, Friday, July 28th, there's 91 X dates on the dividend calendar. There's 91. And of course, we can sort by, dividend, payout. This one pays $5 dividend. Doesn't have percentage of dividend. This one, we can look at indicated annual dividend. But here's where my spreadsheet comes into play. And this is the exact sheet that I've been using. So, that I've created actually. So, we see I've got all my stocks in here. All my stocks. And if you've got Excel, you can, add this in. You can click the symbol there and you can go to data, you can click stocks, and then you can import this data. So that's how I've imported some of this data. This data I got from the NASDAQ website, just here. But this data I've imported because on NASDAQ, it doesn't say price per share or anything like that, or percentage dividend yield. And that's where we want to go for the high ticket dividend payers. So that is where this sliding green scale goes. I've set the formula in Excel to make it greener the higher the dividend is. And, yellow and red if the dividend's really low. See, this is red, and it only pays a 0.8% dividend. The very simple key is if I'm expecting this stock to pay a 2% dividend, I'm also expecting it to fall in value 2%. So how do we evaluate what our expected returns are going to look like when we're doing put options? Because put options are levered up. Each contract represents 100 shares. So they're way more volatile, and they move, a way bigger percentage than the stock. So we went to ChatGPT. We're going to ask it, if a stock goes down in value 1%, how much can I expect my put option to go up? We're going to type enter and have ChatGPT tabulate this for me. For logic questions like this, I find ChatGPT 4 is very good at these type of questions. And if you want to add specifics into your questions, it'll give you those examples in specific terms. So let's start reading. The degree to which the price of a put option will change for a given change in the price of the underlying asset is described by the concept known as delta. Delta is one of the Greeks that option traders use to understand the risks and potential rewards of an option position. It measures how much an option's price is expected to change per $1 change in the price of the underlying security. For put options, delta values range from -1 to 0 because the price of put options moves inversely to the price of the underlying stock. For example, if a put option has a delta of -0.5, the price of the option would theoretically increase by 50% if the underlying stock decreases by $1. So if a stock goes down in value by 1%, the amount that a put option's price would increase depends on the delta of the option. If you know the delta, you can multiply it by the dollar change in the underlying stock to estimate the change in the option's price. I'll read that one again. That was an important sentence. If you know the delta, you can multiply it by the dollar change in the underlying stock to estimate the change in the option's price. I know, very complex, very convoluted. And so we're going to experiment. We're going to choose our highest ticket dividend payers, and then we're going to get put options on them, hold them overnight, and on the X date of the morning, sell them. That's the strategy. So click that notification bell because tomorrow I'm going to be posting a video where I'm actually going to go through this spreadsheet and I'm going to select 5 or 10, somewhere in the middle, dividend payers to hold overnight and sell on the 28th. And we're going to see how this little experiment goes. And I believe this is me thinking strategically that this strategy might pay off in the long run. So thank you everyone for watching this video, and I really hope that you enjoyed it. Hit a thumbs up if you really liked the video. Comment below, to tell me, oh, this is a dumb strategy, or whoa, never thought of this strategy. You can be mean, you can be nice. I just love the comments, love the love, and commenting really helps out the channel as well. We've been growing pretty fast here, and I'm very dedicated to making all these videos for education purposes so that we can learn the stock market and we can learn money together. So thank you everyone for watching. Again, my name is Bruce, and I hope you have a great day. Bye.